All right. Thank you very much for that, Stuart. We are in the green right now, although not as much in the green. The Dow up about 165 points. Of course, we carved out an up week last week, interrupting what had been about a month of losses. Same for technology. Although there are a number of people looking at the technology comeback and saying it isn't what it appears to be, an interesting indicator. They look at forward earnings here that show that it's still rich if you want to look at the technology group as an aggregate. If you look at Apple, Microsoft, Amazon, Tesla, even Meta, and look at those as a group. They're right now trading at about 38, 39 times earnings. If you look at the S&P 500, trading at about half that, actually 16 times earnings, forward-looking earnings, so guidance from these companies. So that could give you some pause to say, all right, well, they've been beaten down enough. By some estimates, not nearly enough. So we'll explore that in a little bit more detail with Jim Bianco, Bianco Research President, macro strategist. Jim, on that comeback idea, particularly for technology stocks, there's a separate camp out there that says, no, with all the, buffeting that we've been seeing, we're not done. What do you make of that?
Well, I think that on the separate camp, you're right that I don't think we're done. There's a bigger picture play at work here. We are in a post-pandemic economy, and I think we are in the process of beginning the restructuring process of changing that. That's the supply chain problems that we're having. That is the cheap energy problems that Europe is having. That is labor issues, that we're not only having labor issues, but also wage growth has been around 5% for the last year or so. If everybody's getting a 5% raise, and that's great, you can pay 5% inflation, and that could be problematic. So yes, when you look at those technology stocks with those big valuations, yeah, it's down a lot from where it was in January, but they're hardly cheap at this point.
I'm wondering if the administration might know something, Jim, that we don't. Planning a number of aggressive announcements on the progress we're making on inflation. I'm thinking to myself, I know we have an inflation report due out tomorrow, the retail inflation report. I don't know what kind of a heads up they get, but the message, and we'll hear more about this from our White House reporter, is that we're through the worst of it. So let me ask you, are we through the worst of it?
Yes, but it might not matter. Yes, we might have seen the high at 9%, but I've argued that that's never been the real issue. If we stayed at 9% inflation for an extended period of time, we'd be in a world of trouble. But the question is, when it starts to decelerate, where does it stop? Does it stop at 2% like the Fed says, or does it stop at 4%? That's an enormous difference. Does that mean interest rates go back to 2 or 2.5? Or do interest rates stop at 4 or 4.5? Remember, they're in the low 3s right now. So does that mean we've got much higher interest rates to go? I fear that 4% might be closer to the long run rate of inflation post-pandemic than 2, which means that interest rates are going to not be anybody's friend. They're going to continue to head higher for a while.
And that's assuming they stop at 4, right? And then you're bringing the inflation rate down to that level. If they're really insistent on getting it down to 2, this is a long haul.
Yes, if inflation does stop at 4 and they say, look, we have to go to tightening, they have to go much above that, you're talking about 5% inflation. That's a problem, especially as going back to the top. If the S&P's forward earnings are 16, well, that might work in a 2% interest rate world, but that definitely does not work in a 5% interest rate world. And so that's why that matters. So yes, 9% might be the peak, but that's not the real issue. The issue is, where do we settle down to? Are we going all the way back to 2, or do we settle at some level higher than that?
Jim, if I can go back to this technology thing, there's a lot of people saying this is what led the parade on the upside and what's been leading the downdraft on the flip side here. And now, some interesting anecdotal developments from just looking at where average folks are putting their money. I noticed that the ProShares Ultra Pro QQQ, a technology bellwether, if you will, is looking at some record one-day inflows. And I'm wondering why that is. Do you think it's premature? Do you think that investors are thinking this is as bad as it's going to get, and I'm going to get back in to see this ride move up again? Where are you on this?
Yeah, mean reversion is a powerful drug on Wall Street. Whenever anybody sees something down, they immediately buy it. Look, you want the ultimate example of that is the ARK Innovation Fund. And I'm a fan of Cathie Wood's, but her fund is down 55% this year, and it's gotten inflows all year. I don't think there's ever been an actively managed fund that has fallen that much and people still hold the faith. And a lot of them, when you ask them, it's because it's down 55%. The next 50% move has to be higher. So there's a lot of this mean reversion thinking going on Wall Street. And to be fair, that worked prior to the pandemic, before 2020. Every time the market stumbled, buy it and it rebounded. But the question is does that still work post 2020? And the record is very spotty on that right now.
Yeah, I always forget that. Just because something's fallen 50% doesn't mean it can't still fall further. Jim, always great having you. Thank you so much.
It can fall another 50%.
Right. Well, all of a sudden, then you're catching a falling knife. All right, let's go to the White House right now. Edward Lawrence and Edward.